Hello everyone and welcome to another Investment Club video. So today we're just going to quickly go over what people mean when they say the market, which can just be a very general term. And also when you talk about investing, a lot of the time people will say, oh, you need to adjust for the market or look at the market, etc., etc. And no one really knows what that means when they're starting off. So first, what I want to draw your attention to is the idea of market cap. If you just go to any type of, finance information system, you'll find market capitalization, 450, the billions. Now, what does that mean? Well, since, as I mentioned in the past, any company can choose how many shares it wants to have, there's no set amount, the total, I guess you could say, stock value of a firm can't be judged by an individual share. It needs to be market cap, which is the number of shares outstanding times the individual share market value. And the reason I put an emphasis on number of shares outstanding means when a company issues stock to people, it's outstanding. But if a company buys it back, then that's no longer included in the outstanding number. So just be aware of that. But for market capitalization purposes, we normally don't worry about that too much. Because when a lot of companies buy what it's called as treasury stock, buy their own stock back and decrease the amount of shares outstanding, normally a ton of companies are doing that at the same time. But anyway, so the market price times number of shares outstanding is market cap. It's sort of an idea of the total stock value. Now, as you can see right here, this is an index, which just means a basket of stocks. And you keep track of the basket of stocks based on its total percentage increase or decrease. So if you were to buy just any number of stocks and just keep track of, how many, what percentage increase or decrease, that's an index. Well, there's some really important indexes out there. The most important one by a lot of people's standards is the S&P 500, which is a listing of the American large cap stocks. Large cap means it has a market cap of 10 billion or greater. So they take all the companies 10 billion or greater, find 500 of them, and then they weight them by market cap. So if you have a really large market cap like Google, you will have a proportional higher percentage than, say, another company that has a smaller market cap. So a way to think about the S&P 500 or any index that's based off of market cap is it's just how much proportional total value does this stock have in this basket. And then they just keep track of all of those values, figure out the total percentage increase or decrease, and then that is the, market. And when people broadly say the market, normally they're referring to the S&P 500. Another popular one is the Dow Jones Industrial Average, or the Dow, but that's really popular mainly because the group that owns the Wall Street Journal owns the group that runs the Dow Jones Industrial Average. So it gets a lot of publicity because of that, but most industry professionals, if they're going to use American stock market, normally you're talking about the S&P 500. Now there's also index, because again these are all large cap, there's also indexes for mid cap stocks, which is between $2 to $10 billion, and then small cap is anywhere below $2 billion. So you have those different options. I believe that most of the time when people are trying to learn basics of investing, what we're going to do is we're going to go after large cap American stocks, aka S&P 500. And as you can see here, the S&P 500 as a whole group represents the market, and then people further divide it into sectors. Sectors are extremely broadly defined. So here you can see S&P 500 current sector weightings. Technology is a large section, almost 20%. And this changes because, again, these are weighted based off of market cap of the stocks inside of them. So Google would be called a technology stock. The technology stock is included in here. If Google and all kinds of other technology firms fall in value, their market cap falls, which means their weighting is going to fall as well. So again, it's just a game of proportions and everything. And as you can see here, this is an ETF, which is essentially just a very clear, concise way of looking at a value of something. So, Vanguard Consumer Staples ETF. That means, as you can see right here, one of the sectors is consumer staples. Well, you could just go to Google Finance, type in consumer staples. I use Vanguard just because it's, really no different, to tell you the truth, than anything else, more like a habit. And you can see I'll hit 1 year. Okay, it's up 7.36% this year. This specific industry, sector, that is. Now, sectors can be divided further into industries, and sometimes there's a lot of very useful information on that as well. So again, the overall idea here is that when we say the market, we're going to talk about the S&P 500, which is a listing of sector weights that represent most of the United States economy, and then we further can divide them into sectors. And these sectors have a lot of meaning, and when we analyze how well a stock does, we normally don't look at just, how did the stock individually do? We compare it to its peers, which a lot of the time is comparing it to its industry and its sector averages. So if you had a company in consumer staples that's up maybe 10% on a 1 year basis, you would consider that a very solid stock. Now, what a lot of people do is they do something called attribution analysis, which we'll go over the mechanics of that next time we meet. But attribution analysis just basically means mathematically breaking something down into how much of the return came from the sector and how much of it came from the individual stock. And we'll talk about this more and make decisions on this, but what a lot of research points to is a lot of investors get most of their returns by choosing the market than they actually do the stock, which makes some people believe that a lot of the time how you weight your market is really big. So if we were to make our own fund, and we say maybe technology we think is going to do exceptionally well, and we thought that consumer staples, for whatever reason, is going to actually just bottom out this year, we may take 3 or 4 percentage points of our total allocation from consumer staples and put it into technology. Well, that process is called under and overweighting. So we're going to underweight consumer staples because we think it's going to do poorly, and overweight technology because we think it'll do well. And again, a lot of research has been done to say, hey, when you do this process, analyzing a sector, and overweighting and underweighting properly, that can actually have a very big, I guess you could say, most of a positive return can come from that process and not through individual stocks. But we're going to discuss this at great length, and we're also going to make some decisions as a club what we want to do. Do we want to go after markets, sectors, or do we want to go after individual stocks? We'll decide. My suspicion is we'll probably just go after individual stocks, at least for the very beginning. Well, thank you very much, and I'll see you at next meeting.